Morning, everyone. I think my screen is coming through there. So I've called my short segment today the Tech Imperative because I think it's absolutely imperative that we take a look around us and take note of the change that we're seeing in the world. And we appreciate the ramifications that has for global capital markets. And by extension, how we position ourselves as investors into that change. But you can't really talk about investing in technology without acknowledging what we've been through as a society over the last 6 months. And I came across a fictitious survey question the other day on Twitter, which I thought encapsulated it quite well. And that is, who has led the digital transformation of your company over the last few months? Has it been your CEO, your chief technology officer, or the virus? And I think the truthful answer in most instances is it's been the virus. And it's caused companies to adopt technology on a scale that would never have been the case before the pandemic ensued. And I thought, well, this is a really interesting question. And I think you could probably rephrase it from an investor's perspective as well. And ask, who's led the digital transformation of your portfolio? And of course, the answer is the virus. And you've seen that play out in the market, where, for example, year to date, the S&P 500 is flat, but the broader tech sector is up by more than 20%. And it's led to something that I've come to term the Zoom effect, because I think it's this trend's nicely represented by the Zoom share price, where stocks like Zoom are up several 100%, 300 in this instance, relative to a flat market. And I think it's left a lot of investors feeling like the little guy standing on the books over there, where you can't quite grasp the valuations in that space. And you may be feeling a little bit left behind, or that it's too late to invest in tech now. But the truth is, there's no such thing as the Zoom effect. This is really a continuation of a trend that's been in place for the last 10 years. And to illustrate that, what I've done is I've graphed the performance of the NASDAQ, which is a tech-heavy index relative to the S&P 500 over the last 10 years. And you can see that the NASDAQ has outperformed by around 200%. And that's life-changing money for an investor. And this is due to very measurable, fundamental reasons that I'm going to touch on a little bit later. But I do think that the current dynamic leaves investors in a fairly tricky situation, because you've got shorter term and longer term driving forces acting against one another in the tech space. So on the short term side, no doubt you've had defensive rotation into tech stocks. People are buying technology companies because they've been less impacted or unimpacted by the pandemic. And there's certainly an element of fear of missing out as well. People are worried that they're going to miss out on the next Zoom. But I don't, and that's pushed valuations into full or even uncomfortable territory. But I don't want that to distract you from the more important longer-term driving factors. And I'm going to touch on those three now. But the point I want to make on this slide is that the present sort of dichotomy between those shorter and longer-term factors favors an active management strategy. I think active managers like ourselves are in a good position to still identify those strong secular growth stories while remaining cognizant of valuation. So just to get into the factors that I believe will continue to drive outperformance from the tech sector. The first is the absolutely massive research and development spend that we're seeing coming out of that space. Technology companies are spending more than any other sector on growth and innovation. And what I've done to illustrate that is I've just tabulated the collective R&D spend by the 5 largest US tech companies over the last 10 years. And you can see that the total in the bottom right-hand corner there is around $900 billion. So Alphabet, Amazon, Microsoft, Facebook, and Apple have spent, if you annualize it, around 1/3 of South Africa's GDP every year on new initiatives and new ideas. And equally as astounding is that they're earning an average return of around 20% on that reinvestment. So every year, just these 5 companies are creating around $200 billion in additional shareholder value. So it makes sense that these companies are benefiting from the future, right? Because they're spending the money to create that future. The second driving factor that I want to talk about are the superior economics that technology companies demonstrate. And I think they're best explained through a principle called network effects. And network effects are really a phenomenon where as technology companies become bigger, so they become more efficient and they start to grow more quickly. And I like to use Amazon as an example. So where Amazon garner more sellers, so the platform becomes more attractive to buyers. And conversely, as Amazon gains more buyers, so the platform becomes more attractive to sellers. And over time, Amazon can extract more economic value from the platform. So that theory makes sense, doesn't it? But I think to really hit that point home, I want to use a real world example. So what I've done on this chart is I've actually graphed the market value of two different big blue chip companies going all the way back to 1996. The first is Procter & Gamble, and I think that's a great example of a blue chip stock that a lot of you would have held in your portfolios over the years. This is a company that pays out around 70% of its profits as a dividend. They reinvest the other 30%, and they earn a return of around 10% a year on that reinvestment. And you can see that the value creation for shareholders over time has taken place in a fairly linear fashion. Amazon, by contrast, the orange line, is a typical technology company, which reinvests every single cent of its free cash flow back into growth, back into new initiatives. And what I want you to take note of is, as the company has become larger, so the rate of value creation for shareholders has started to increase at an exponential rate. And the fascinating statistic for me is that today, even as one of the world's largest companies with a market capitalization of over $1.5 trillion, it's still managed to double in value over the last 2 years. And that's so typical of the tech sector. And it makes two important points for me. So one, you have to have an allocation to the tech space for a long time, because typically the value creation is back-end loaded. It only comes through in the later years. And secondly, you have to hold the course for that same reason. And lastly, the really important driving factor, I guess, is the relentless innovation that's coming out of that space. And what I've done is I've just taken 4 themes that really excite me, and hopefully it gives you some insight into why we hold some of the positions in our fund. And the first is contextual commerce. Now, contextual commerce is really just a really new and efficient way to sell things. So if you think about the way retail's operated in the past, it's really been there to service the needs of someone who's already decided to buy something, right? They've seen an advert and now they're searching for the item, whether it's in a shopping center or on Amazon's website. But contextual commerce is different. It's a principle that creates a need where there wasn't one before, and it hits you with an advert when your psychological and emotional propensity to spend money is at its highest. So for example, when you're on Instagram and you're a hiking enthusiast and you're looking at pictures of hiking and you're imagining planning your next hiking trip, and all of a sudden you see an advert for these new hiking boots, your emotional and mental propensity to spend money at that point is much higher than it would be in a shopping center. And then almost in a genius way, they give you the option to spend the money right at that point. And I think this is going to become far more prevalent over time. And I think Facebook, with their Instagram property, are the best positioned company to benefit from that trend. The second one is distance learning. And I think not only has technology made it possible for students to attend a virtual college far more cost effectively than a physical college in person, but it's also allowed for the development of shorter format, more focused courses that are tailored towards specific job opportunities. And I actually think that the end of the generic 4-year bachelor's or 4-year undergrad degree is near. Now, Chegg is a business in the US that we own. They've been leading the charge. They've got around 4 million subscribers and it's growing at 30% per annum. But there was some interesting news last week. I don't know who of you would have seen it, but Google have actually come out with a series of short-form courses called professional certificates. Now, these are 6-month-long courses that cost around $50 a month to complete, and they're tailored to positions that the company wants to fill within its own business. But the important point to make is management have said they're going to treat those 6-month certificates on the same level as a 4-year undergrad degree for hiring purposes. So I think that's a real harbinger for things to come. The third trend is podcasting, and I think it's a huge opportunity for advertisers. So in the past, when you've displayed an advert to someone, whether it's in print media or on TV or even on social media, you're generally displaying an advert to someone who is very distracted. So your hit rate's quite low. But if you think about when you're listening to a podcast, you're actually in a very heightened state of mental engagement. And if you can display a related ad effectively to the person when they're in that sort of mindset, I think the ROI on that advert, your hit rate with that advert will be much higher. So Spotify is a business that we own. They're leading the charge in the podcasting space, and that's a theme that I'm really excited about. And the last one I want to talk about is what I call the direct-to-consumer phenomenon. So lately, a lot of businesses are using technology to build direct relationships with their customers. They don't need intermediaries anymore. And Disney is a great example at the moment with their Disney Plus streaming service. So I think a lot of the parents in the audience today would know that the forthcoming $200 million blockbuster Mulan is going to be released directly to the public via Disney Plus. It's not going via cinemas for obvious reasons. And they're going to charge $30 for the privilege of downloading it. Now, the significance of that is in the past, when Disney released a new movie, they would only participate in around 60% of box office revenues. But now with a direct release, they're going to enjoy 100% of those box office revenues. So by using a direct-to-consumer model, it's very obvious that a company like Walt Disney is going to become more valuable over time. So I hope that gives you some insight into how we think about investing in tech, and some of the ideas that we're excited about. And I thought I would just end off by touching on some of the primary objectives of our technology fund. And that is, we aim to meaningfully outperform global equity markets over time by taking relatively concentrated positions in high conviction ideas. Our portfolio turnover will typically be quite low. So in other words, when we buy a stock, we plan to hold it for a long period of time. And typically we won't buy positions where we feel there's less than around 50% upside to fair value. We're very happy with the performance of the fund to date. Since the 6th of June last year, it's returned roughly 63% in rands or 40% in dollars. And we think the fund's worthy of your consideration.